Saurabh, good to have you back. Thank you for joining us. Saurabh, a month
Morning.
ago there was a drought in the market, almost a drought. FIs were selling, nobody wanted to buy India, everybody wanted to go to China, and now looks like there is a feast. DIs are buying, FIs are buying, Saurabh Mukherjea is buying, everybody is buying, nobody wants to sell. What has changed in last 1 month?
I think the blow up of the Western banks and specifically the blow up of American banks has clearly had an impact. So if you see the amount of bond buying that the Fed does, somewhere around middle of March, when these the First Republic and SVB etc. started blowing up, the Federal Reserve started buying bonds, and that continues. And once a global investor, a foreign investor, sees that the Fed is now buying bonds, pumping dollars into the market, it becomes relatively easy for them to take a call that the rupee is not going to give up more ground. And thus you have as you were mentioning a few minutes ago, Nikunj, thus you have the return of the FII to the Indian market. Whether we like it or not, whether even our clients like it or not, the sorts of stocks people like us buy in Marcellus, the sorts of stocks you guys are flashing up on the screen, are the stocks that FIIs like. So in the last 6 weeks, basically in this financial year, our portfolios up are 8 or 9%. Although earnings compounding stays the same old 20-25% that it's been this year, last year, the year before that. But the return of the FIIs is largely driven by their realization that the weakness of the rupee or the strength of the dollar is now something that is largely behind us. And thus you're seeing roughly $1 billion a week of FII money coming into our market.
Reading a Morgan Stanley report in the morning, and sort of the Birlas are convinced that they want to challenge the paint market. The Jindals are convinced that they have opportunity in the paint market. Pidilite is convinced that there's opportunity in the paints market. But you are not convinced, and you still feel that Asian Paints, nobody can challenge it. I mean, I understand it's a sumo. It's been the sumo of the paint market, right? But guess what? There are other sumos who are going to be challenging it now.
So, Nikunj, everybody who plays IPL wants to be Virat Kohli, right? Everybody who plays cricket wants to be Virat Kohli. So I did the maths once. I looked at roughly there are 500 players
It's
in the
Dhoni for
IPL,
me.
roughly 100,
Saurabh,
150
Saurabh,
are
let's
foreigners.
let's get the
Three,
favorites right. It's Dhoni for me.
so no, what I was
No, no, no,
saying was
Dhoni. We have to agree. I watch for Dhoni, not for Virat Kohli.
three cricketers, Dhoni, Rohit, and Virat take
Okay, now you're
home.
making a good comeback.
Right, so the Dhoni, Rohit, and Virat take home 80% of the prize money and the advertising dollars that Indian cricketers get. I think corporate life is very similar. There are plenty of companies who want to be Asian Paints. That will always be the case. Why shouldn't they? Why shouldn't they aspire to be a 35% ROCE, 20-25% compounding machine? So aspirations are going to be there forever. But in every industry, paints included, we are seeing two players take away 80% of the profits, and the rivals, the aspirants will keep coming. It's incumbent on the sorts of companies you're flashing up on the screen. It's incumbent on them to build their muscle, their fitness, their competitive advantages, and see off the rivals. So using that cricket analogy, I was trying to make the point that the Birlas have valid aspiration. Why shouldn't they? JSW Paints, ditto. Pidilite yesterday announced that they want to do it. But the comparative advantages of Asian Paints in paints, Pidilite in adhesives, Bajaj Finance in NBFC lending are such that it's very, very difficult for rivals to come and have a meaningful impact on these franchises.
Saurabh, I don't know whether this is a recent one or not, but I believe that you've made a large addition, and that's Tata Elxsi to your portfolios. Why is that?
So back in December when we exited Jan when we exited Relaxo in our mid cap portfolio Rising Giants, we bought a Tata Elxsi. So on the theme of dominance, we discussed some dominant franchises in the design of automobiles, in the design of say OTT platforms as front end, in the design of many of the features we see in mobile phones. Tata Elxsi is increasingly emerged as a global leader. And as auto design moves away from the Purana mode, which was once in 10 years, a Toyota gets a refresh or a Honda gets a refresh, as we move away from that into a car design refresh cycle, which is more like what Apple does with its phones, the addressable market for Tata Elxsi, we reckon, has expanded significantly. So it's a dominant player, it's the largest in India in engineering engineering and industrial design services, and its specific depth in designing in the auto sector, in the OTT sector, in the mobile sector, led us to make this a portfolio addition back in January. The stock hasn't done much, I think, for the last couple of years, but if you look at the 20-year track record, the 10-year track record, both in terms of growth, free cash flow generation, it's impeccable. Just a quick disclaimer, all of these stocks that I'm mentioning, I own them, my parents own them through Marcellus, and our 10,000 clients have positions in these stocks.
You wouldn't address that bullish rationale onto the other IT services mainstay companies, would you?
So just to be clear, firms like LTTS and Tata Elxsi, which are in our portfolio, they're more in engineering and industrial design services. This is slightly different from IT services. In IT services, TCS remains our mainstay. In some of our advisory portfolios, we have Infosys. And I think, as I've said over the last couple of years, I remain astonished that people in our country, investors in our country, buy and sell firms like TCS and Infosys on the IT cycle, because to my mind, it's a one-way story. The demand for Indian IT services is unrelenting. The Fortune 500 companies don't really have any other credible place to go to cater to their demands. The migration to cloud is only 1/3 done. So there's a huge growth runway. And TCS, to my mind, is the strongest moat in India on the supply side, right? The main trick in IT services is you need to be able to recruit 1 to 2 lakh people, train them, hold on to them, and monetize them in front of clients. And I don't think TCS does it. I don't think anybody does it better than TCS. I thought the recent results was plug plain. I think a lot of people were disappointed. I loved the recent results. You bring in $10 billion of business in the midst of a Western banking crisis and war in Russia, Ukraine. You give me 25% operating margins. And you give me roughly 16% PAT growth. Those are the sorts of results we at Marcellus like. So TCS remains a big holding in our flagship product.
Much of volatility within IT. If the cloud story and the cloud opportunity is so large, and it could be a multi-year or a decadal opportunity where cloud lakes are getting created, transformation has just about started. Why is that 2 quarters ago IT companies were guiding for something different, and 2 quarters later they are guiding for something different? Why is there so much of cyclicality in a business where there is a linear proposition of growth?
Absolutely. So nice point, Nikunj. I think it's very similar to what we see in say in Indian tech, right? A year ago, had you spoken to Indian tech companies, Indian unicorns, I mean, they were flush with cash. They were spending loads of money on hiring people. If you look at Indian unicorns today, money is tight. They're actually getting rid of people rather than hiring people. So that dynamic also has a bearing on the US tech ecosystem. And a firm like TCS has some exposure to that. But the biggest exposure that TCS will have is US financial services, US banks. And as we know, given the state of the US banking system at the moment, it would be a remarkable American banking CEO who signs a major new contract with TCS, right? So the near-term guidance that TCS is given is rightfully cautious. But if you and I sit here and say 1-year earnings, even 2-year earnings really don't have that much influence on the valuation of a company, it's the next 10 years I'm interested in. It's difficult to see why in the next 10 years, A, the West will not move to the cloud, and B, if it does move to the cloud, it's difficult to see why they won't hire TCS to do that work for them. So it's that ability to in a way, ignore short-term noise and take the long-term view, which creates strong compounding. And I think that's our job, and that's why I thought the Q4 results were both an honest assessment by a credible management team of near-term challenges, but at the same time, the Q4 results were also a clear indication of the sheer muscle that this company possesses and provides to its shareholders.
Projected earnings for FY24 and FY25 are expected to grow in the range of about 13 to 15% depending on the estimate you look at. That may not be the case for IT. IT at best would be, early double digit or 9 or 10%. So does it make sense to buy into IT where the projected earnings could be 8 to 10% when the aggregate earnings will be higher than that?
Right. So I think one way to look at it is to look at free cash flows rather than earnings growth. So in the case of a firm like TCS, as you can imagine, there isn't that much incremental capex required. In fact, there's negligible incremental capex required. This is not Tata Steel or an industrial giant, and therefore the entire PAT that you generate ends up becoming cash flow to shareholders. The biggest shareholder for TCS obviously is Tata Sons, and they end up getting 11,000-12,000 crores a year from TCS via the dividend. For shareholders like us, we get a dividend, but we also see the free cash flow generation even in weak years, such as possibly the year ahead. Even in weak years, you're getting 11-12% free cash flow compounding. In good years, you're getting free cash flow compounding pushing 20%. If you take a 20-year view of that, say take 15% free cash flow growth, 16% free cash flow growth over a 20-year cycle, you're getting valuations significantly north of the current valuation. I would venture to say you get a fair value for TCS somewhere double the current share price. So take a realistic estimate of the year ahead, say 11-12% free cash flow growth. Some years, the boom years will be closer to 20. On average, you're looking 15-16%, conservatively 15-16% free cash flow growth over the next 20 years. By the way, they've done much better over the last 20. Over the last 20, they've done 20% free cash flow growth over 20 years. But even if you take a reduced number, 15-16% free cash flow growth over 20 years, this company is significantly undervalued, we reckon.
Saurabh, since we're talking about Rohit Sharma, Virat Kohli and all the cricketers, why don't I add one more? Rahul Dravid, that silent, stable performer. Who do you think, which stocks do you think would really fit that list when it comes to the entire financial space, given what you have in the portfolio?
Yeah, I think, Avan, you know what I'm going to say. I think I'm going to mention a bank whose name starts with H. Bank which, I think after the HDFC Bank, HDFC Limited merger, this will become India's largest PAT generator, largest profit generator. By our estimate, this will generate 8-9% of the nation's PAT. Incredible number, right? Nothing like it has ever been seen before in Indian history. One corporate generating 8-9% of the nation's PAT. Last 4 years, PAT has compounded. In fact, 5 years, PAT would have compounded at 22%. Shares would have compounded at 5%. We love it. I can't tell you how much I love it when things like this happen. It sort of makes our life worthwhile. That you have a compounding machine of this scale, this ferocity, this efficiency operating quietly, humming away, making billions of dollars, and it's available at a steal, and we keep buying some of it every day.
Everybody not buying it. You're making it sound very simple, right? Buy HDFC Bank and go to sleep. I mean, you're making it sound very simple. But you're making it sound simple is very logical also. But if it is so obvious and so logical, then why are there so many naysayers? What are markets worried about?
So Nikhil, let's take HDFC Bank as an example, right? It was listed in 1995. And the story is well known. I'm sure every investor in India knows the HDFC Bank story under Aditya Puri and now under Shashi Jagdishan. If you look at the shareholder register, foreigners own 75% of it, right? And the only reason foreigners don't own 100% is the RBI put a limit on the foreign ownership at 75. Otherwise, the foreigners would have owned the entire bank. And I think that remains the big challenge for domestic investors. Their inability to take the long view means that assets like this, companies of this quality, $110, $120 billion of wealth, a compounding machine of enormous strength, ends up in the hands of foreign investors because the domestic investor takes the short-term view, looks at PB multiples and PE multiples, and ends up buying, say, a public sector bank rather than a compounding machine of this strength. And similar story, somewhat similar story with Kotak Bank. In front of you, in front of everybody, in broad daylight, a wealth creation machine has been built, which ends up being majority owned by foreigners because domestic investors tend to be slightly more myopic. They take a short-term view and end up missing out on this. Now, if you want to put it in another format, in a typical 5-year cycle, there'll be 1 to 1.5 years when the foreigner runs away, right? You mentioned it that when we spoke 2 months ago, I remember coming to studios for the budget day, foreign money wasn't there. Even through February, March, foreign money wasn't there. In a 5-year cycle, 1 to 1.5 years, the foreigner will run away because the rupee will be weak through that period. In that 1.5 years, a gap opens up between earnings compounding and fair value. And that gap is like a laddu, right? We just have to grab that laddu and make the most of it. So this is when Rahul Dravid, to take Avan's hint, this is when Rahul Dravid steps on the accelerator, gets the run rate going and hits the century or the double century. These are the opportunities that the Indian market provides when the foreigner takes a holiday from India. Stocks like the ones that you're flashing up on the screen end up becoming super attractive.
Okay. So, Saurabh, they say you never say never in the market, but can I say that it will always be never, never, never when it comes to Adani Group of stocks for you?
I think the general point we made repeatedly over the last 5 years is look at ROCEs, look at free cash flows as a measure of a company's compounding ability, right? So whether it is the companies we invest in or the companies that we don't, the rationale remains the same. Clean accounts, a history of sensible capital allocation resulting in sensible return on capital, 15 ke upar, 15 ke upar return on capital, and dominant franchises, which give you and me visibility on large free cash flows stretching well into the future, stretching 10, 20 years into the future. The result of this mixture that we look for is fair value PEs, which are well north of 100. The stock market typically gives us these stocks at 40, 50 PE. We load up on them, and we load up even more when in years like the fiscal just ended, when I think our portfolios were down anywhere between 15 to 20%. We buy as much as we can. And then when the foreigner returns, everybody then buys the same stocks, they roll up, and then we go through the same cycle all over again. So clean accounting, good free cash flows, dominant franchises. We keep looking for that. And the good news is India gives us plenty of those at significant discounts to fair value.
Okay.